Hey everyone, welcome to Chapter 9D, Ratio Analysis Made Simple. In the next few minutes, we're going to decode how analysts actually measure a company's financial health using key ratios. These ratios are like a health report for any business. They tell us if it's profitable, efficient, stable, or over-leveraged. So let's jump right in and make sense of the numbers that matter. Let's start with the first category, profitability ratios. These tell us how efficiently a company turns its sales into profit. Gross profit margin is found by dividing gross profit by sales, and it tells us how much profit the company makes after covering production costs. Operating margin, which is EBIT divided by sales, shows how well the company runs its core operations. And finally, the net profit margin, or net income divided by sales, reveals how much profit the company keeps after all expenses. In short, higher margins mean better pricing power and cost control, two signs of a strong business. Now let's move to efficiency ratios. These show how effectively the company uses its assets. The asset turnover ratio is sales divided by total assets and tells us how much revenue the company generates from its assets. Inventory turnover is cost of goods sold divided by inventory. The higher this number, the faster the company sells its products. Debtor days tells us how many days customers take to pay, calculated as receivables divided by sales and multiplied by 365. And creditor days measure how long the company takes to pay its suppliers. The best businesses collect cash quickly and delay payments smartly. That's operational efficiency at work. Next up are return ratios. These show how well the company generates returns on the money invested. Return on assets, or ROA, is net income divided by total assets, showing how efficiently management uses its resources. Return on equity, or ROE, measures how much profit shareholders earn on their invested capital. And return on capital employed, or ROCE, looks at EBIT divided by the total capital used, which includes both debt and equity. Higher return ratios indicate stronger financial performance and better use of investors' money. Now let's talk about liquidity ratios. They answer a very simple question. Can the company pay its short-term bills? The current ratio is current assets divided by current liabilities, and ideally should be above 1. The quick ratio, or acid test ratio, removes inventory from assets before dividing by liabilities, giving a clearer view of liquidity. And finally, the cash ratio tells us how much of the company's liabilities can be paid immediately with cash. A higher liquidity ratio means greater safety, but too much cash sitting idle can also reduce profitability. Coming to leverage ratios, these highlight the company's debt and risk profile. The debt to equity ratio compares total debt to shareholders' equity to show how much of the company is financed by borrowed funds. Debt to asset ratio compares debt to total assets, revealing the overall leverage level. The interest coverage ratio tells us how easily the company can pay its interest using earnings before interest and tax. And the debt service coverage ratio, or DSCR, measures how comfortably a firm can cover its total debt obligations, including repayments. In short, higher leverage means higher risk, but also higher potential reward if managed wisely. Next, let's move to growth ratios. These show how fast a company can grow sustainably. The retention ratio, also called the plowback ratio, is 1 minus the dividend payout ratio and tells us how much profit the company reinvests. The sustainable growth rate combines ROE with the retention ratio to estimate how fast the company can expand without raising new capital. And EPS growth measures the percentage increase in earnings per share from one year to another. A company with consistent EPS growth and healthy reinvestment is usually a solid long-term bet. Finally, we have the valuation ratios. These show what the market is willing to pay for a company's earnings or assets. The price to earnings ratio, or PE ratio, is price per share divided by earnings per share. A higher PE often means investors expect future growth. Price to book compares the share price to book value per share and helps gauge if the stock is over or undervalued. Price to sales shows how much investors pay for each rupee of sales, while EV to EBITDA compares enterprise value to operating profit to assess overall valuation. Dividend yield and earnings yield show the return investors get relative to the stock price, and the PEG ratio divides the PE by earnings growth to see if the price is justified by performance. Together, these ratios help analysts decide whether a stock is cheap, fair, or expensive. And that's your complete overview of ratio analysis in just a few minutes. From profitability and efficiency to liquidity and valuation, these metrics give you a 360-degree view of how strong or weak a company really is. If you found this breakdown helpful, hit that like button, share it with your finance friends, and subscribe for more chapters from the NISM Research Analyst course. Until next time, keep learning and keep analyzing smart.